AIM-listed Orcadian Energy is looking to develop the pilot oil field in the North Sea. It's committed to bringing on oil production into a cleaner and greener process. Steve Brown is the Chief Executive Officer, and he joins us now on the line. Steve, it's a pleasure to be able to catch up with you. It's a good time as well because the company's working towards this point of production. You're not in production yet. Explain more about what Orcadian is trying to achieve here.
Right. Well, we're recently listed on AIM. We listed in the middle of last year, and although we've been around a long time, it's getting listed that's really given us the impetus to drive this project forward. And we listed with 79 million barrels of 2P reserves that are focused in the pilot project. And the pilot project is the heart of what we're trying to progress. We've made great progress on that. We actually submitted a concept select report to the OGA last year, and we got approval from the OGA of the selected concept right at the end of last year. And that's very important because since the OGA switched its strategy to encompass net zero goals, there's actually been a little delay in projects getting through their approval processes. And in fact, in terms of projects getting FDP approval, field development plan approval, up until very recently, none had got through that process. We've gone through the step before that, which is the concept select approval, and recently Ithaca went through an FDP approval. So we think the North Sea is back in business. We think that the industry really learned how to develop fields with much lower emissions, and we've been leading the way in that. And that's the key for new developments happening in the North Sea.
Of course, this goes a long way to assuage the concerns about the environmental lobby, which of course is gaining a lot of political momentum as much as anything else. And of course, we're talking in the wake of the COP26 conference in Glasgow just a couple of months ago. Explain more about this idea about this cleaner, greener process that you're trying to achieve. Does it ultimately add extra cost onto per barrel? That's the other big question that investors will want to know.
If you're going to take an existing producing oil field and decarbonize it, that's going to cost you money. But when you're at the concept selection phase, you've got opportunities to actually take advantage of some of the benefits of going cleaner and reduce some of your costs. So for example, with pilot, one of the things that really helps our emissions profile is our choice of polymer flooding as a reservoir recovery mechanism. So, typically with a viscous oil field, what you do is you inject water and you wait 30 years. You cycle around lots and lots of water around the reservoir, and that gets you your oil out. Polymer flooding changes the flood front within the reservoir, and what happens is you compress the field life and you reduce the fluid handling requirements. And that ends up roughly halving emissions compared to a conventional approach. So that's the first thing we did to reduce emissions. We adopted polymer flooding, and it really helps if you've got a viscous oil field. The next thing we did was we completely reinvented the way we managed process heat within the facilities, and that halved emissions again. And then the next thing we did was we incorporated a floating wind turbine to help supply energy, and that halved emissions again. And when we look at the total cost impact of that, it's less than 1 or 2%. So if you can make the changes in the concept phase, the cost impact is not so big.
So overall, you're confident to get government approval and the green light when you get that opportunity to prove that this is going to work and you've got the resources and you've got the money in place. It's going to be a go, is it, from the government?
I'm absolutely convinced of that. I think, to be perfectly honest, we're setting a precedent for the rest of the industry on how to go about decarbonizing new development schemes. And I'm confident that when we get the financing in place, and of course that's a big job for us to be focused on, when we get the financing in place, that the government will support the project. Of course, there's more work for us to do. We have to prepare an environmental statement and so on and so forth. But we know what that entails, and we're confident we'll get through that process.
Well, let's pick up on that, because clearly that is something that, again, investors really want to know about, because it's pointless investing in a company that's going to have to take either too long, or it's going to be too much of an obstacle to get the money in on a project. How confident are you that, one, you're going to get the money, two, what sort of money are you talking about, and over what period is it going to take you to raise that money to get production up and running?
So let me start with the second question, which is, what's the quantum of money? We're looking around about $900 million to get to first oil. So it's a very substantial sum of money. There's clearly debt capacity within the project, but there's a limit to how much banks will lend on field development projects. So we'll need to attract some equity one way or another. One obvious route is to bring in a partner on the project. Another way to bring equity is to issue some shares, but we're very focused on dilution. There will be dilution to get to first oil, beyond a shadow of a doubt, but we're very big shareholders in the company, and we will take the path that minimizes that dilution and maximizes the value to current shareholders. So if you want to sit alongside us in this project, we're absolutely aligned with shareholders.
Okay, time period. When is production likely, and what's the what sort of milestones you've got along the way, including obviously raising the money to get you to that that production?
So the first thing is to get FDP approval from the government. But to get the FDP approval, you have to be fully financed. That's one of the rules they have. And we're aiming to do that. I always hesitate to give timetables and financing, because the truth is it's as long as a piece of string. And you've been financed when you reach the end of that piece of string. But our target is to do that 4Q, 1Q next year, that kind of time frame. We've got a work program in mind to get all that done. And once we have the project approved, it's a 30 to 36 month project. So we're talking about being in production in 2025.
Just to clarify as well, are you a fully approved project? Because my understanding is that you have to be fully approved to be classified as having reserves. You've got 2P reserves, 79 million barrels. There seems to be a little bit of a mismatch on what one would normally regard as a qualification here.
Yeah, I mean, it's a really interesting point, and one that I like to talk about. Were 2P reserves justified for development? There's another category called 2P reserves approved for development. So obviously, you have to be fully approved to be in the approved category, but the justified category exists for a reason. And the reason is that there are projects which still have work to do to get through the approval process, but they're economic. The reserve auditor thinks they're likely to get finance. They've got a market for the product. It's possible to put all the equipment there to get it done. There's actually 7 criteria. And for your more nerdy listeners, I recommend they go to SPE PRMS 2018 clause 2.1, 2.1, and they're all laid out there, the 7 criteria that allow you to be classified as reserves. And the key thing about our reserves is they're not contingent. Lots of companies have contingent resources, but they're all contingent on something. So something has to happen. An appraisal well has to be drilled. An economic development plan has to be designed. Maybe if you've got a gas contract, often you have to sign a gas sales contract, so on and so forth. So, we don't have any of those contingencies. We've got lots of work to do. I'm not diminishing that in any sense, but there's none of those contingencies that can provide some nasty surprises.
Just talking about the field itself, why, I'm not sure who it was that owned this before Orcadian took it on, but why weren't the previous owners attempting to do what you are trying to do? I mean, presumably there may be some questions, I guess, over this idea about polymer flooding. I don't know how reliable this is as a method as much as anything.
Yeah, I mean, That's a really interesting point again. This field was discovered by FINA back in the early 90s. Then Total bought FINA and they had it for a while. They sold it to Venture. Venture put together a development plan that didn't work out. They didn't go through with it. Then Enquest had it. Actually, when you look back at the time period that all those companies had this opportunity, throughout that time period, it was a great reservoir with a viscous oil in it. And people's view of what the oil in place were pretty consistent. But what changed, and it actually started to change in 2013, but we really didn't know about it until 2018, was confidence in implementing polymer flooding offshore. And what really changed things was in 2013, Chevron did a trial of polymer flooding on the Captain field in the North Sea. And that was a roaring success. They published that in 2018. That's when the industry got to find out about it. Since then, Chevron's sanctioned phase 1 of the Captain polymer flood. Ithaca, the owner of that field now, have sanctioned phase 2. They're putting another 400 million into it. And we've realized that actually polymer flooding can really work for our fields. And that wasn't really apparent until 2018. So, this is a classic example of the industry proving up a technology and us being able to take advantage of that progress.
Let me just quickly bring up a share price chart, because I think it's worth looking at that in the context of what we've been talking about with this with these 2p reserves. You're currently trading at 37.4 pence on the AIM market here in London. This gives you, I think, a value of about £24 million. You're talking about having to raise 900 million. I take it that's $900 million, is it? Because we normally talk about dollars in terms of that sort of target when you're talking about that in the international oil markets. Just explain where this share price is in the context of what it is you're offering shareholders. Clearly, there's a time to wait before production comes online, if and when. But what is this buying you, 37 pence? I mean, how does this represent the value in the company at the moment?
Yeah, so we don't just have the pilot field. We've got 2p reserves in pilot. Those are actually the most valuable barrels. We've also got another 78 million barrels of contingent resources. We need to do some appraisal on those, so there's some further money to spend on it. But that's 150 odd million barrels of 2p plus 2c. If you divide that into our market cap, that's 21 cents a barrel. People go out and explore, and their target is actually to create something that's worth $1 a barrel or thereabouts. So, we think there's a value gap there. That's an opportunity for investors who can buy in the market. We wouldn't raise money at this price. We'd aim to be raising money at a higher price as things progress and people get more confidence in the project. So we think it's a great opportunity for shareholders to buy. You might say, you would say that, wouldn't you? But, do the numbers, do the math, as they say in America.
So let me just wrap it all up and take a step back and ask you, what's in your in tray immediately? What should we expect as people watching this story from here on in to indicate that you are achieving the points of interest along the way? What's next in the pipe?
Well, one of the things we're working on at the moment is actually a project we've undertaken with the Oil and Gas Authority to look at how to electrify existing platforms in the North Sea. So it's taking all the learnings we've had from that concept select process and looking to apply them for existing producing platforms. And it might seem like a distraction, but for us, it's a great opportunity. We think there's actually an opportunity for us to create a business there, but we're actually also evaluating all the floating wind technologies that we could possibly use for that process and for pilot. And it turns out there's actually 40 different floating wind technologies out there, and we're not certain we've identified them all. So we'll be making progress on that project, and we hope to be delivering a report to OGA by the end of March. And that's probably the next thing that we will talk about to the market, unless some other things that we're working on come to fruition, and then I'm able to talk about them.
Look, Steve, we'll have to leave it there, but thanks indeed for joining. It's an interesting story. Orcadian Energy. Steve Brown, he's the Chief Executive.